Right then, settle in,
Right.
because we're about to embark on, well, a rather profound deep dive today. We're aiming to cut straight through what might, at first glance, seem like some pretty dense financial jargon. Our mission today is to really illuminate the intricate, often bewildering landscape of global accounting.
It certainly can be bewildering.
Absolutely. When one mentions accounting, the mind might naturally drift to spreadsheets, calculators, maybe a, well, rather sedate affair.
That's the stereotype, isn't it?
It is, but trust me, by the close of this discussion, you'll see it's a remarkably dynamic, even pivotal field. It impacts everything from your favorite multinational's financial health right through to the very stability of the global economy.
Couldn't agree more.
So we're here to unravel the complexities of these diverse financial reporting standards, the thorny challenges of international taxation, and those often underestimated cultural nuances. We want to provide you with a crystal clear understanding of what all of this genuinely means for companies, for investors, and, well, indeed, for all of us.
Yeah.
Our guide on this journey is a rich set of excerpts from Contabilità Globale, Sfide Convergenza, a truly insightful source, actually, that delves into the core challenges and the ongoing efforts towards convergence in this fascinating arena.
Precisely. And it's quite remarkable, isn't it, how a topic often perceived as purely technical can possess such profound global implications.
It really is.
In our increasingly interconnected global market, the mere existence of multiple accounting frameworks presents a fundamental systemic challenge.
Right.
Imagine, if you will, a multinational corporation trying to present a consistent and, transparent picture of its financial health across dozens of countries, each with its own specific set of rules.
Nightmare.
It's akin to trying to play a global game of football, but, well, with different rules in every single stadium.
Yeah.
This inherent divergence creates significant hurdles, not just for the companies themselves, obviously, but for anyone trying to understand or invest in them.
Yeah.
And what's truly fascinating here, I think, is that this seemingly dry topic of accounting standards directly impacts how effectively a company can attract capital, how seamlessly it can operate across borders, and ultimately how robust and trustworthy the global financial system can truly be for every stakeholder involved.
And speaking of those differing rules, those different stadiums, we absolutely have to begin our exploration with the two undisputed titans, really, of global accounting standards. That's the International Financial Reporting Standards, or IFRS, and the Generally Accepted Accounting Principles, or GAAP, which is predominantly used over in the United States.
That's right, the big two.
Exactly. These aren't just two distinct rule books. They actually spring from fundamentally different philosophies. IFRS is widely recognized as being, well, principle-based, whereas GAAP leans heavily towards being rules-based.
A crucial distinction.
It is. So for you, our curious listener, if you were considering the practical implications for a company, what strikes you as the most significant difference between a principle-based and a rules-based approach in accounting? Is it, on the one hand, a greater sense of flexibility, allowing professional accountants more interpretive latitude? Or on the other hand, is it B, a much stricter adherence to detailed prescriptive instructions, thereby minimizing the need for individual judgment? What's your initial thought there?
That's an excellent way to frame it, actually, and it really cuts to the core of their design. Let's maybe delve into the underlying why behind these philosophies.
Okay.
So IFRS, being principle-based, it offers broader guidelines. It essentially says, look, here are the overarching principles. Now apply your professional judgment to fit these to specific situations.
Right. Apply the spirit of the law, perhaps.
Kind of, yes. This approach can indeed provide greater flexibility. It allows companies to adapt their reporting to very unique business models or perhaps complex transactions that might not be explicitly covered by a rigid rule. You could think of it as a painter being given a theme and a palette of colors, but allowed to interpret the scene as they see fit.
Nice analogy.
But of course, this flexibility also means it requires more interpretation, and that admittedly can sometimes lead to variations in practice, even among companies ostensibly applying the same principles.
I see. Potential for inconsistency, maybe.
There is that potential, yes. Now, US GAAP, conversely, as a rules-based system, provides highly detailed, almost encyclopedic, instructions and procedures for financial reporting. It aims for precision and consistency.
Okay.
So imagine our painter now being given a detailed blueprint with every single line and color specified.
More prescriptive.
Exactly. This meticulous approach offers a high degree of clarity and comparability within the United States, because companies generally follow very specific prescribed steps. Yet, this can also make it less adaptable, arguably, to the myriad of unique scenarios that multinational companies frequently encounter across the highly diverse global markets they operate in.
Right, less wiggle room.
Precisely. It's a trade-off, really. IFRS champions professional judgment and adaptability, while JAP prioritizes uniformity and strict adherence to established procedure.
So it's a clear choice then, isn't it, between well, the nuanced brushstrokes of interpretation and the precise lines of a blueprint.
That's a good way of putting it.
But this isn't just a philosophical debate for academics, is it? These differences manifest themselves in truly concrete and significant ways, profoundly impacting a company's reported financial picture.
Oh, absolutely.
Let's really dig into some specific divergences, because this is where the genuine real-world impact becomes undeniably apparent.
Definitely. As they say, the devil is often in the detail, and in accounting, these details can shift millions, literally. Take, for instance, inventory treatment.
Okay.
This is a classic point of divergence that can dramatically alter a company's reported profitability. Under IFRS, the last in, first out, or LIFO method of inventory valuation is strictly prohibited.
Right. LIFO is out under IFRS.
Completely out. This means a company using IFRS cannot assume that the last goods it purchased are the first ones it sold when calculating its cost of goods sold. Instead, they typically use first in, first out FIFO, or maybe weighted average methods.
Okay.
Now, in periods of rising prices, which, let's face it, is often the case using LIFO as permitted under U.S. GAAP.
Ah, so GAAP allows it.
Yes, GAAP permits LIFO. Using it means a company reports a higher cost of goods sold because it's effectively selling its most expensive, recently acquired inventory first.
I see.
This then leads to a lower reported net income, which, crucially in the U.S., can translate into a lower tax liability.
The tax angle, of course.
Exactly. So imagine two identical companies, one in the UK using IFRS and another in the US using GAAP, perhaps selling the exact same widgets. Their reported profits could look quite different simply because of how they account for the same inventory.
Wow.
It's a bit like deciding whether to price your goods based on what you last paid for them or what you first paid. This seemingly technical difference can lead to significantly differing cost of goods sold and net INGRI figures, truly altering a company's reported profitability depending on its inventory flow assumptions and, well, the inflationary environment.
That's a huge potential difference. What else?
Then we consider revenue recognition. Now, IFRS, under its sort of performance-based model, generally recognizes revenue when the control of a good or service transfers to the customer.
Okay, when the customer gets the value.
Essentially, yes. Think of it as when the customer effectively takes possession of the value promised. For instance, if you sell a software license under IFRS, you might recognize the revenue when the customer gains access to the software and can actually start using it.
Makes sense.
GAAP, while it has seen some convergence with IFRS in this area recently, there was a big joint project resulting in ASC 606.
Ah, yes, I remember that.
Right. It traditionally used a more structured five-step model that emphasizes the realization and earning process. It focused on whether the entity has satisfied its performance obligations and has an enforceable right to payment.
So, slightly different emphasis.
A slightly different path to get there. While the underlying principles have certainly moved closer, the specific nuances and interpretations can still impact precisely when revenue hits the books. And that, of course, affects quarterly and annual results and, by extension, investor perceptions of growth and performance momentum.
Timing is everything in reporting, isn't it?
It really can be. Another key divergence appears in asset valuation.
Okay, how assets are valued on the books.
Exactly. IFRS permits the revaluation of certain non-financial assets, think property, plant, and equipment, to reflect their fair value, provided these revaluations are applied consistently and fairly across the board.
So you can mark things up to market value.
Under certain conditions, yes. This means a company's balance sheet under IFRS might show assets at values closer to their current market worth. This can sometimes provide a more, well, up-to-date picture of a company's true economic resources.
Right.
U.S. GAAP, however, generally adheres strictly to the historical cost principle. This means assets are reported at their original purchase price, less any accumulated depreciation, regardless of what their current market value might be.
So potentially a big difference there, too.
Oh, huge. This divergence can lead to vastly different asset bases on balance sheets. It profoundly affects the perceived financial strength, the capital intensity, and even certain financial ratios of a company. It's the difference, really, between valuing your house at what you paid for it decades ago versus what it's actually worth today.
That's a very clear way to put it. Any others jump out?
Yes, and then there are development costs. This is often relevant for tech or pharmaceutical companies.
R&D spending.
Precisely. Under IFRS, if certain strict criteria are met, things like the technical feasibility of completing the intangible asset, the intent to complete it, and the ability to actually use or sell it, then development costs can be capitalized.
Meaning treated as an asset.
Exactly. They are treated as an asset on the balance sheet and then expensed over their useful life, much like how a machine might be depreciated over time.
Okay.
US GAAP, by contrast, typically requires these costs to be expensed immediately as incurred. They hit the income statement in the period they occur.
Straight to the profit and loss.
Right. The result. A direct and often significant impact on reported profitability in the periods these costs are incurred, and also on the asset figures on the balance sheet. A technology company investing heavily in R&D might appear significantly more profitable in the short term under IFRS than under GAAP.
Even if they're doing exactly the same thing.
Exactly the same thing, just because of this difference in accounting treatment.
Yeah.
Finally, let's touch on lease accounting. This has recently been a major area of, well, reevaluation and convergence, but differences remain.
Okay.
IFRS now requires nearly all leases, whether previously classified as operating or finance leases, to be reported on the balance sheet. You get a right-of-use asset and a corresponding lease liability.
So bringing leases onto the balance sheet.
Pretty much all of them, yes.
Yeah.
This significantly increases both reported assets and liabilities for companies, particularly those with extensive leased assets, like, say, airlines or big retailers. It makes their balance sheets appear more leveraged.
Right. More debt visible.
Correct. U.S. GAAP, while also moving towards balance sheet recognition with its own standard, ASC 842, continues to allow leases to be classified either as operating or finance leases. There are certain nuances that can still lead to different financial statement presentations compared to IFRS, especially maybe for shorter-term or low-value leases.
Still not perfectly aligned.
Not perfectly. This particular discrepancy can have a significant influence on perceptions of financial health, particularly things like leverage ratios and debt covenants, and it can alter reported profitability. It really underscores the vital need for greater transparency and understanding when comparing companies globally. You need to know which rule book they're playing by.
Here's where it gets particularly thought-provoking, isn't it?
Yeah.
These aren't just arcane academic distinctions for accountants to, well, ponder amongst themselves.
Not at all.
These technical differences have profound, measurable, real-world consequences for how companies are presented to the outside world, especially to investors. It fundamentally shapes how capital is allocated globally.
Absolutely fundamental.
So, considering these rather distinct differences we've just explored, if you, our astute listener, were an investor attempting to compare two seemingly similar companies from different countries,
Yeah.
say a German firm using IFRS and an American one using GAAP, which of these specific discrepancies do you think would be most challenging or even potentially misleading if you weren't fully aware of the accounting standard being applied? Would it be, on the one hand, A, the differing valuation of assets, perhaps making one company seem considerably wealthier or more capital-intensive than the other?
Mm-hmm.
Or, on the other hand, would it be B, the distinct treatment of leases on the balance sheet, which could significantly alter perceived debt levels and leverage, which feels like the bigger potential pitfall?
That's a truly astute question for anyone endeavoring to make sense of global financial data. It requires real care, and it naturally leads us to think about how multinational corporations actually manage to navigate this increasingly complex labyrinth.
Yes, how do they cope?
Well, the sheer burden on these firms is, quite frankly, immense. They often find themselves in the unenviable position of preparing not just one, but quite frequently two, or sometimes even more, sets of financial statements.
Wow, multiple sets.
Often, yes. One set is typically to comply with local regulations in each country they operate in for local tax and legal purposes, you see. And another is to comply with international standards, like IFRS or their home country's GAAP for consolidated reporting to global investors and their primary regulators back home.
That sounds incredibly resource-intensive.
It is, which raises an important question. How do these colossal global companies manage this overwhelming complexity without simply drowning in administrative costs? Or, even worse, facing significant audit issues and potentially severe regulatory penalties?
Good question. What's the secret?
Well, the answer largely lies in a combination of sophisticated strategic approaches, meticulously robust internal control systems, and critically, the deployment of advanced enterprise resource planning, or ERP, platforms.
The big IT systems.
Exactly. These systems are essentially the backbone that allows them to collect, process, and report financial data consistently across myriad jurisdictions, translating between standards where necessary.
Absolutely. It's about far more than just crunching numbers. It's about strategic agility and maintaining a coherent financial narrative across the globe.
Yeah.
Let's maybe illuminate this with some real-world examples, looking at how giants like Nestle, Apple, and Toyota actually tackle these daily complexities.
Good idea. Case studies are always helpful.
Consider Nestle, for instance. As a Swiss-based global food and beverage leader, it operates in over 180 countries. I mean, that's just a mind-boggling scale.
It's truly global.
Their primary consolidated financial statements are prepared under IFRS, which is the norm for many European and globally listed companies. However, every single one of their thousands of subsidiaries, whether it's in America, Brazil, or Indonesia, must rigorously comply with the local generally accepted accounting principles, the local GAAP in the countries where they are registered.
So IFRS at the top, local GAAP underneath.
Precisely. This creates a dual obligation. They need to ensure accurate local compliance for tax and regulatory purposes, and then meticulously reconcile all those diverse local accounts into IFRS-compliant consolidated statements for their global investors and the Swiss regulators.
A huge reconciliation task.
Immense. Their accounting teams are constantly grappling with challenges like varying rules on revenue recognition for distinct product lines across different jurisdictions, how assets are depreciated in disparate legal environments, and highly nuanced tax accounting specifics unique to each region. This demands not just immense technical knowledge, but an extraordinarily coordinated oversight structure across their vast global enterprise. It's essentially a complex internal translation service for financial data.
You need specialists in dozens of different GAAPs, plus IFRS.
Exactly. Then we have Apple, a titan headquartered in the United States, meaning its consolidated reports are prepared under U.S. GAAP.
Right, the opposite situation in a way.
Yes, Apple faces similar, if inversely challenging, complexities. Its global operations span regions that predominantly use IFRS-based systems, so they require localized accounting adjustments and multiple financial disclosures to satisfy local requirements before rolling everything up into GAAP.
GAAP consolidation, but needing IFRS inputs.
Right. Think about the intricate process of consolidating revenue from their enormous hardware sales, their booming service subscriptions like Apple Music or iCloud, and their various licensing agreements. Each of these revenue streams might encounter differing criteria for recognition across different regions, influenced by local regulations or specific contractual nuances. Apple has to account for these variations while still rolling up into a single, consistent, GAAP-compliant consolidated report. It's a colossal task.
Especially with their scale and complexity of offerings.
And finally, consider Toyota, the Japan-based automaker. With a massive manufacturing and sales presence in both the U.S. and Europe, Toyota contends with both GAAP and IFRS reporting systems quite significantly.
Straddling both major systems.
They do. Their strategic ability to integrate both systems is truly impressive, actually. It allows them to present financial statements that not only satisfy local tax authorities in different countries, which are often very particular about local compliance,
Understandably so.
but also appeal to their vast international investor base, who might be more accustomed to either GAAP or IFRS, depending on where they are. It's a testament to the sheer sophistication and technical prowess required to operate at this global scale, where accounting isn't just about recording history, but about enabling a seamless global business strategy.
These real-world examples brilliantly underscore the profound operational, regulatory, and strategic implications of accounting in a truly globalized business environment, don't they?
They really do.
These companies aren't just preparing statutory reports, they're actively managing vast, interconnected financial ecosystems. These case studies highlight the growing need for highly harmonized internal systems, where financial data can flow seamlessly and be translated or reconciled between different accounting standards with minimal friction.
Systems and people.
And people, absolutely. More importantly, they vividly demonstrate the critical importance of highly skilled accounting professionals, those who are not only technically proficient in multiple standards, but also possess a deep, nuanced understanding of international regulations and the strategic foresight to navigate complex, multi-standard financial landscapes.
Global accountants for a global world.
Exactly. If we connect this to the bigger picture, it becomes abundantly clear that robust and adaptable accounting is not merely a compliance burden. It is, in fact, an absolutely crucial strategic asset for any global business's success. It impacts its ability to expand into new markets, attract capital efficiently, and maintain unwavering investor and public trust.
That's a brilliant point. It really transforms accounting from a mere back office function, as you say, into a core strategic asset.
Hmm.
Now, let's shift our focus slightly to one of the most intricate and, quite frankly, often contentious aspects of global accounting, international taxation, and more specifically, the challenging realm of transfer pricing.
Ah, yes, the thorny issue of transfer pricing.
Indeed. For those less familiar, transfer pricing is essentially the method by which multinational corporations value internal transactions. That's things like goods, services, or intellectual property when they move between related entities, subsidiaries located in different countries. It's akin to how a parent company charges its subsidiary for something it provides.
Setting internal prices across borders.
Precisely. So, for you, our listener, here's a thought. Why do you think this seemingly internal accounting mechanism has become such an intense focal point for tax authorities around the world in recent years? What's the underlying concern here?
Well, it's become a critical focal point precisely because it directly influences where profits are officially reported,
Right.
and consequently where tax revenues are ultimately collected by national governments. Tax authorities are now highly scrutinizing transfer pricing to combat what's known as profit shifting and tax base erosion.
Okay, shifting profits to low tax places.
To put it simply, yes. This is when companies, through clever and often entirely legal internal pricing, move taxable income from high tax jurisdictions to lower tax ones. The differences in corporate tax rates and the varying levels of enforcement across different countries create very strong incentives for companies to structure their operations and, crucially, their internal transactions in ways that minimize their global tax burden.
The incentive is definitely there.
It is, and while these practices can often be entirely within legal boundaries, they do, as you mentioned, raise significant ethical and compliance challenges, leading to intense scrutiny from regulators and, increasingly, from the public, who often view it as a fairness issue.
Understandably.
The core difficulty for companies, and indeed for tax authorities, is the sheer lack of uniform global tax standards. This makes it incredibly difficult for multinational companies to design a single, coherent approach to tax accounting that works seamlessly and indisputably everywhere.
A global tax system is a long way off.
A very long way off. Consider this common scenario. A multinational might manufacture products in a country with a very low corporate tax rate. Then, perhaps, it licenses its invaluable intellectual property, a patented technology, or a globally recognized brand name from a separate entity situated in an even lower tax jurisdiction. And finally, it sells the finished product in high-revenue markets with much higher tax rates.
A typical structure, maybe.
Quite typical. Now, allocating the profits generated across these distinct entities becomes an incredibly complex accounting exercise. How much of the final profit is genuinely attributable to the manufacturing process? How much to the intellectual property that allowed the product to be made? And how much to the sales and marketing efforts in the final consumer market?
Tricky to pin down.
Very. The answers to these questions have substantial implications for the company's reported earnings in each country, and, more critically, its overall global tax liabilities.
And governments want their share.
Exactly. Regulators and governments, acutely aware of potential tax avoidance and the erosion of their tax bases, have responded by significantly tightening rules around transfer pricing documentation. Multinational companies are now required to provide incredibly detailed disclosures and robust justifications for their intercompany pricing strategies.
More paperwork, more scrutiny.
A lot more. This often includes strict compliance with guidelines from influential organizations like the Organization for Economic Cooperation and Development, the OECD.
Yes, the OECD's BEPS project.
Exactly. The Base Erosion and Profit Shifting, or BEPS, framework was developed specifically to combat these aggressive tax planning strategies. The BEPS initiative has led to a major international push for greater transparency and common standards, trying to align profit with where value is actually created.
A big international effort.
It is. For accountants operating in this environment, navigating these complex and constantly evolving requirements demands not just technical precision, but also significant strategic foresight and a keen understanding of global economics. Any errors or inconsistencies in transfer pricing documentation can lead to incredibly costly audits, severe penalties, and significant reputational damage in an age of increased public scrutiny.
High stakes.
Very high stakes. As governments become more coordinated in their enforcement efforts, companies must strike a delicate but absolutely crucial balance, optimizing their tax position, which is, let's be clear, a legitimate business goal for any company,
Sure.
versus demonstrating a clear commitment to ethical and transparent financial reporting. What's truly fascinating here is that accounting professionals are not merely number crunchers in this landscape. They play a vital strategic role in ensuring that global tax strategies align with both the company's broader business objectives and the increasingly complex and ever-evolving web of international tax regulations. It's a real tightrope walk that requires immense skill.
That's a brilliant exposition of a truly tricky area, isn't it? It highlights just how much is at stake, not just for companies, but for national treasuries worldwide.
Absolutely. Billions are at stake globally.
So for you, our listener, when you consider the multifaceted challenges of transfer pricing, which aspect do you believe poses the greater ongoing challenge for multinational corporations? Is it, on the one hand, A, perpetually navigating the constantly changing and often conflicting regulations across myriad different countries, making compliance an incredibly difficult and moving target? Or, on the other hand, is it B, meticulously balancing the very real business goal of tax optimization with growing public and regulatory expectations for ethical behavior and transparent profit allocation across global operations? Which is the tougher balancing act?
Both are, without a doubt, formidable challenges that demand constant attention. But perhaps a significant part of the solution, or at least a crucial enabler for managing this complexity, lies squarely in the realm of technology.
Technology to the rescue.
To some extent, yes. As the intricacy of global accounting continues to increase at an almost exponential rate, technology has truly emerged as a critical enabler of efficiency, accuracy, and rigorous compliance. Multinational corporations now rely heavily on advanced accounting systems to manage vast amounts of financial data that span multiple countries, different currencies, and diverse regulatory environments.
Indispensable, really.
Absolutely. Enterprise resource planning, or ERP platforms, the industry leaders like SAP and Oracle have become absolutely essential tools in this endeavor. They are the central nervous system for a global business.
Connecting everything up.
Exactly. These platforms enable companies to consolidate financial information from various business units, whether they are manufacturing plants in Asia, sales offices in Europe, or research centers in North America, into a single unified system. This unification is key.
One source of truth?
That's the goal. These powerful platforms allow companies to integrate specific local accounting standards and reporting requirements into their workflows, while simultaneously producing consistent, comparable financial reports at the group level, ready for consolidation. With the help of such technology, finance teams gain the capacity to monitor performance in real time, quickly detect anomalies or discrepancies that might otherwise be hidden in vast data sets, and respond much more swiftly and effectively to any new regulatory changes or evolving compliance demands. It's like having a universal translator and a real-time health monitor for your entire global business.
That sounds powerful.
It is. And beyond these foundational ERP systems, exciting and transformative innovations like artificial intelligence, AI, robotic process automation, RPA, and cloud computing are fundamentally reshaping the way global accounting is performed.
The next wave?
Definitely. For instance, RPA can automate highly repetitive, rule-based tasks, think invoice processing, bank reconciliations, or large-scale data entry that traditionally consumed vast amounts of human time.
Freeing people up?
Precisely. This automation drastically reduces human error, which is a significant benefit when dealing with complex global data, and critically, it frees up accounting professionals to focus on higher value activities, such as in-depth analysis, strategic planning, and identifying opportunities or mitigating risks.
More strategic thinking.
Yes. AI-powered tools, on the other hand, are increasingly being deployed for more cognitive tasks. They can detect subtle fraud patterns that might be invisible to the human eye, flag inconsistencies in vast financial data sets that might otherwise go unnoticed for years, and significantly enhance the quality and efficiency of internal and external audits by quickly sifting through millions of transactions.
Finding needles in haystacks.
In a sense, yes. Furthermore, cloud-based accounting systems are revolutionizing collaboration. They allow geographically dispersed teams to access and update financial information simultaneously from anywhere in the world, fostering far greater collaboration and transparency across international borders, making a truly global accounting operation possible without physical proximity.
So it sounds like an exciting, perhaps even daunting revolution for the accounting profession itself.
It certainly is.
But it's not without its own set of significant challenges, is it? One can't simply plug in a new system and expect magic.
Not at all. You're absolutely right. While technology offers immense potential for efficiency and insight, its adoption also introduces substantial new hurdles that global companies must meticulously address.
Such as?
Well, Data security, especially in a global context, is a paramount concern. Companies must ensure that incredibly sensitive financial information, often spanning consumer data, intellectual property, trade secrets, is rigorously protected across different legal jurisdictions, each with its own unique and often stringent data privacy regulations. Think of GDPR in Europe, for example, or various data sovereignty laws elsewhere.
A patchwork of privacy rules.
Exactly. Additionally, the challenge of integrating cutting-edge new technologies with existing legacy systems, which many large established multinationals still operate, can be an incredibly complex, time-consuming, and costly endeavor. It's often not a simple swap.
Ripping out old systems is hard.
Very hard. And crucially, ensuring that staff have the necessary training, upskilling, and understanding to effectively utilize these advanced tools requires significant ongoing investment in human capital. It's about people adapting to new ways of working, not just implementing new systems.
The human element.
Always critical. Despite these hurdles, the strategic use of technology has become absolutely indispensable for global businesses. It's the critical key to meeting the ever-growing demands of international financial reporting, adeptly navigating complex compliance landscapes, and ultimately optimizing performance management in a highly competitive and fast-evolving global market. The ability to effectively leverage digital tools will increasingly distinguish companies that can maintain agility and integrity in the global marketplace, separating the leaders from those perhaps left behind.
It's clear that technology isn't just an optional add-on anymore. It's truly foundational to modern global accounting.
Couldn't agree more. Foundational.
So thinking about this profound digital transformation, for you, our discerning listener, which specific technological advancement do you believe holds the most transformative potential for global accounting over the next decade? Is it, on the one hand, A, artificial intelligence for its unparalleled capabilities in fraud detection and deep data analysis, promising unprecedented insights and enhanced security? Or, on the other hand, is it B, cloud computing for its revolutionary ability to enable real-time collaboration and seamless data access across borders, fundamentally reshaping how global teams work together, which feels more game-changing?
A tough choice. Both are incredibly impactful.
That's a truly fascinating point to ponder, isn't it? Now, let's pivot slightly to an aspect of accounting that often gets overlooked amidst the focus on numbers, regulations, and technology, but which is absolutely critical: the profound influence of culture and ethics.
Yes, the softer side, but hugely important.
Hugely. Here's where it gets particularly interesting, because accounting is most certainly not practiced in a neutral cultural vacuum. What's considered transparent or even just good financial practice in one country might be seen as insufficient or even potentially misleading elsewhere. So how does this rich cultural backdrop actually influence financial reporting globally?
It influences it quite profoundly, actually, shaping not just the specific technical practices, but often the underlying philosophy of reporting itself. National attitudes toward risk, toward regulation, and even toward authority deeply shape not only specific accounting practices, but also the very ethical standards that guide accountants and auditors in their daily work.
So it goes beyond just the rules.
Oh, absolutely. These subtle yet powerful differences permeate decisions, from how conservatively or aggressively revenue might be recognized in certain markets to how much detail is actually included in financial disclosures and the accompanying notes within a company's annual report.
Can you give some examples?
Sure, let's explore some examples of this often unseen cultural influence. Consider risk tolerance, for instance. Okay. Countries with a relatively high tolerance for uncertainty, such as, say, the United States, might actually encourage the use of fair value accounting and frequent revaluations of assets. This can introduce more volatility into financial statements, but aims to reflect current market realities more closely.
More responsive to market changes.
Yes. Conversely, more conservative societies, perhaps like Germany or Japan historically, tend to favor historical cost accounting and a much stronger emphasis on prudence in financial reporting.
Okay. Prudence being key.
Exactly.
Yeah.
This means they often err on the side of caution, recognizing losses quickly but gains much more slowly. They aim for reliability and stability over perhaps immediate responsiveness to market fluctuations. These cultural tendencies directly impact how financial statements are prepared and, crucially, how they are understood and interpreted by local stakeholders, investors, banks, regulators in those countries. It's like preferring a steady, predictable journey over a potentially faster but maybe bumpier one.
That makes sense. What about culture within the company?
Good point. Then there's organizational culture. In some jurisdictions, a strong emphasis on hierarchy and formality within organizations may inadvertently discourage junior employees or even middle managers from questioning financial irregularities.
Fear of speaking up.
It could be due to cultural norms around respecting authority or perhaps a reluctance to rock the boat, as they say. Whereas in others, more open organizational cultures are actively promoted, encouraging ethical whistleblowing and fostering robust internal accountability mechanisms. These differences directly impact the effectiveness of internal controls and the likelihood of detecting and addressing financial misconduct. Internal audit processes might function quite differently because of this.
Right, how open the communication channels are.
Exactly, and these differences extend to enforcement and compliance as well. Some countries impose incredibly strict penalties for accounting violations and deviations from standards, indicating a strong regulatory hand and perhaps a low societal tolerance for non-compliance. Others might allow for more negotiation or discretion in regulatory matters, reflecting a different societal approach to rules, and their enforcement may be favoring collaboration over confrontation in some cases.
Different regulatory styles.
Yes, and ethical expectations also vary quite significantly, particularly in areas like aggressive tax planning, earnings management, where companies try to smooth out their profits to appear more consistent to investors, and the level of transparency and disclosure they provide.
What's considered acceptable?
Exactly. Practices that might be considered aggressive but perhaps perfectly legal in one country could be viewed as highly unethical or even illicit in another, despite technical compliance. Therefore, global companies face a profound challenge. They must develop internal accounting policies that not only comply with the letter of the law in every jurisdiction, but also reflect a coherent, consistent ethical stance that can be consistently upheld across diverse cultural settings.
A global ethical standard for the company.
That's the ideal, but it's hard. This task becomes even more critical as companies face increasing scrutiny from regulators, investors, and the public, all of whom expect consistent integrity regardless of geographic location. This raises an important question. How do accounting professionals truly navigate this intricate web of differing norms? They need not only technical brilliance, but also a deep sensitivity to local cultural nuances, combined with an unshakable ethical compass and a truly global mindset that transcends national borders.
That's a truly crucial insight, isn't it? It's not just about what's legally permissible, but what's perceived as right and proper across different cultures, which can be a very different standard indeed.
A very different standard sometimes.
So, for you, our thoughtful listener, when an accounting professional is navigating these deep cultural differences in global business, which aspect do you believe presents the greater challenge? Is it, on the one hand, A, meticulously adapting to different national attitudes towards risk and prudence in financial reporting, which directly impacts the very numbers on the page? Or, on the other hand, is it B, ensuring that consistent ethical standards are genuinely upheld across varying cultural interpretations of what is considered acceptable business behavior, which requires more careful navigation?
Both are inherently complex, to be sure, but I agree the ethical dimension often carries a particularly nuanced and perhaps more subjective challenge.
All right.
And this brings us rather elegantly, actually, to our final overarching theme, the path forward and the persistent yet crucial quest for global convergence in accounting standards.
The Holy Grail, perhaps?
Well, some see it that way. As globalization deepens and international capital flows become even more interconnected, the need for a truly unified global accounting framework becomes increasingly urgent, or at least appears to. One of the most persistent and debated questions in the accounting profession centers on whether full convergence between the major accounting standards, primarily IFRS and US GAAP, is actually feasible or indeed even desirable in the first place, given the deep-seated differences we've discussed.
Feasible or desirable? Good question.
Efforts toward this convergence have been ongoing for literally decades, spearheaded by influential international bodies like the International Accounting Standards Board, the IASB,
Based in London.
and the Financial Accounting Standards Board, the FASB, in the United States. These efforts have, it must be acknowledged, yielded some notable alignment in key areas. We mentioned revenue recognition and lease accounting earlier. Those big joint projects brought IFRS and GAAP significantly closer on those specific topics.
So some progress has been made.
Definitely. However, despite this technical progress, significant political, economic, and institutional barriers continue to limit the full harmonization of standards. If we connect this to the bigger picture, it's not just about finding common ground on technical rules, it's about navigating deeply entrenched national interests and sovereign control over economic policy.
So, all right, let's unpack this a bit further. What are these specific stubborn obstacles that continue to prevent full harmonization, even after all these years of dedicated effort by so many brilliant minds? It seems like such a logical goal on the surface.
Indeed, it does seem logical, but the reality is far more complex than just technical alignment. The primary hurdles are deeply rooted in broader geopolitical and economic realities rather than purely accounting theory.
Okay.
One of the most significant obstacles is simply national interests and regulatory sovereignty. Countries are, quite understandably, often profoundly reluctant to relinquish control over their national accounting rules.
They want to set their own rules.
Naturally. These rules are deeply intertwined with their domestic legal systems, their national taxation policies, and even their specific economic and industrial strategies. Accounting standards are not merely technical, they reflect and influence national economic policy and priorities, making them a matter of national self-determination. Giving up control means giving up a tool for domestic policy in a way.
I see.
Then there's the U.S. resistance, which has historically been quite significant. The United States has shown deep-seated resistance to fully adopting IFRS.
Why is that mainly?
Well, it stems from a number of fundamental concerns. There's apprehension about a potential loss of oversight to an international non-governmental body, the IASB being a private foundation, remember. There are significant worries about the enormous potential costs of transitioning their entire corporate reporting system, which would affect every single publicly traded company.
A massive undertaking.
Huge. And there are fundamental differences in their legal environments compared to many IFRS adopting countries, particularly regarding litigation risk. Their rules-based system has evolved over decades within their specific legal context, and changing it wholesale would be a titanic undertaking with potentially unpredictable consequences for their vast capital markets.
Fair enough. Any other roadblocks?
Furthermore, there are inherent competitive dynamics between the standard-setting bodies themselves, like the IASB and the FASB. Each body has its own history, its own stakeholder groups, auditors, preparers, users, and its own vision for what constitutes best practice in accounting.
Institutional rivalry?
Perhaps a bit of that. And let's not forget the powerful influence of entrenched industry lobbying groups within various countries who have vested interests in maintaining certain accounting treatments that specifically benefit their sectors or established business models. For instance, the banking sector might prefer certain financial instrument classifications, while real estate or manufacturing might favor others. All these political and economic factors create layers of complexity that go far beyond mere technical accounting differences, making full, identical convergence a very distant, if not perhaps impossible, aspiration.
So lots of hurdles beyond just the technical rules.
Absolutely. Despite these formidable challenges, however, the undeniable trend toward increased comparability and transparency in global financial reporting is highly likely to continue.
Why is that?
Well, the driving force behind this is clear and unwavering. Multinational corporations and investors increasingly demand standardized or at least highly comparable information to make informed decisions across borders. It simply makes a global capital allocation more efficient, more transparent, and ultimately less risky.
Market forces pushing for it.
Very much so. Technology also plays a crucial role here. It may, in fact, accelerate a de facto convergence by enabling systems that can seamlessly translate or reconcile different accounting standards in real time, even if the underlying rules aren't perfectly identical. This technological bridging can make the practical impact of differences less burdensome over time.
Technology smoothing over the differences.
Potentially. In the long term, full convergence may not necessarily mean identical rules everywhere. Instead, it's more likely to evolve into perhaps a common core of principles, supported by consistent interpretation and application across major economies. This approach could offer both a necessary level of standardization for global markets and the flexibility required for diverse national contexts to retain some unique aspects.
A compromise, maybe?
Possibly. For the accounting profession itself, this vision of increasing convergence calls for a more globally minded workforce. Professionals will need not only deep technical expertise in both IFRS and GAAP, perhaps, but also acute cultural awareness and a nuanced understanding of regulatory landscapes across different jurisdictions. The future of accounting isn't just about crunching numbers. It's about navigating global interconnectedness and translating financial realities across a diverse world.
Absolutely. It's about truly understanding the entire global tapestry behind those numbers, not just the individual threads themselves.
Well said.
So, considering all the significant obstacles we've discussed, The national interest, the resistance, the practical complexities. For you, our thoughtful listener, which factor do you believe is the single biggest hurdle to achieving truly unified global accounting standards? Is it, on the one hand, A, national government's understandable reluctance to surrender regulatory control, driven by sovereign interests and deeply tied to domestic policies? Or, on the other hand, is it B, the immense practical costs and inherent complexities for businesses worldwide to transition to a completely new single standard, potentially disrupting operations on a global scale? Which is the bigger mountain to climb?
Another difficult one to weigh up.
Well, what an enlightening journey that was.
Mhm.
We've truly taken a deep dive into the fascinating, albeit wonderfully complex, world of global accounting.
It certainly is complex.
We've thoroughly unpacked the distinct philosophies and specific divergences between IFRS and US GAAP, highlighted the immense challenges faced by global corporate giants like Nestle, Apple, and Toyota in navigating dual reporting systems, and explored the intricate complexities of international taxation and transfer pricing.
Covered a lot of ground.
We did. We then turned our attention to the transformative, indeed revolutionary, role of technology in bringing efficiency and accuracy to this intricate field. And finally, we shone a crucial light on the often overlooked but profoundly influential role of culture and ethics in shaping financial reporting practices worldwide. So what does all of this mean for you and for the world? Well, it means that global accounting isn't merely about columns of numbers. It's a dynamic, ever-evolving field shaped by a powerful interplay of economics, international law, cutting-edge technology, and even deeply ingrained cultural norms. It's a critical, often unseen pillar of our interconnected global economy, constantly demanding adaptation, foresight, and a really nuanced understanding.
Indeed. And perhaps to leave you with a final thought to mull over as you go about your day. In a world that increasingly values transparency, comparability, and ever closer interconnectedness, could the continued existence of significantly divergent accounting standards ultimately hinder global economic efficiency and perhaps even erode trust? Or does it perhaps offer a necessary and valuable flexibility for diverse national economies to retain their unique financial identities and policies? It's a complex question, isn't it? One with no easy answers, and one that will certainly continue to shape our global financial landscape for years to come. We certainly encourage you to keep exploring these concepts and the profound impact they have on our increasingly globalized world.